Our last topic is on the financial statements. This is another very important topic as it is something we will be discussing all semester long. The first financial statement that we will discuss, and probably the most important one, is the income statement. The income statement describes a company's revenues and expenses along with the resulting net income or loss over a period of time due to earnings activities. We will list all sources of revenue and all expenses on this statement. I will show you an example of these statements in the next few slides. Next is the statement of owner's equity. This statement is not as popular as the income statement. The statement of owner's equity explains changes in equity from net income or loss and from any owner investments and withdrawals over a period of time. It will show the owner's capital at the beginning of the time period and how it changed over the time period to give us an end result. Next is the balance sheet, which is a popular one. It describes a company's financial position, types and amounts of assets, liabilities, and equity at a point in time. This statement will show the accounting equation. We will total all our assets and have that equal the total of all of our liabilities and equity. The last statement is a statement of cash flows. This statement identifies cash inflows and cash outflows over a period of time. This is an important statement, but we will not discuss it any further until the Accounting 2 course. We will now go over each statement individually. We do need to prepare these statements in order because information from one statement is needed on the next and so on. The first statement that should be prepared is the income statement. As I previously stated, this will show all revenues and all expenses. Revenues minus expenses equals net income. If the number is negative, then it will be a net loss. The way the statement is set up is first to have a header. The header will include the company name and the type of statement we are looking at, which is the income statement in this case, and the period of time. It's important to have the time period because you can prepare an income statement for a 1 month time period, a quarter, a year, or any other variation that suits your needs. In this case, I would know that this is the income for a 1 year time period. Usually there aren't too many revenue accounts. Most businesses only have a few revenue streams. You would list all your revenue accounts, put in the totals on the left-hand side, and then total it on the right-hand side. Next, list all of your expenses. Most businesses have a lot of expenses. There would be more expense accounts than revenue accounts. I've seen small businesses with only a handful of expense accounts and larger businesses with 100 expense accounts. You would do the same thing here by listing all the values on the left-hand side. You would then total it on the right-hand side. You would subtract the two numbers to find your net income or your net loss. It is important to do this statement first because the amount of net income or loss will be needed on the next statement. The statement of owner's equity is prepared second. Students usually have a more difficult time filling out this statement. However, we are not going to be using this statement much over the semester. You begin by putting in the header. The statement starts with the beginning capital. If this was a brand new business, it would be 0. If it is not a new business, you would put the ending capital from the last time period in here. What you end one period with, you will start the next period with. You do your additions first. You would add any new investments from the owner during this time period if there were any. Next, you would add net income if there was any. This amount is the net income from the income statement, which is why you prepare the income statement first. Total these numbers. Next, you would do your subtractions. If the owner withdrew any money from the business for personal use, that amount would go here. If there was a net loss instead of net income, that would go here as well. Please note that you are never going to have both net income and net loss at the same time. It will be one or the other. Subtract these numbers from your previous total to arrive at ending capital. Note that this would be your beginning capital for the next time period. The ending capital is needed to prepare the balance sheet next. The final statement that we will look at is the balance sheet. Remember, the balance sheet shows the accounting equation. We will list all the assets on the left side. We will then list all the liabilities and equity on the right-hand side. The total for equity is from the statement of owner's equity. Remember that assets equals liabilities plus equity. The totals at the bottom need to equal total assets, total liabilities, and equity. The balance sheet can also be formatted differently than what I'm showing you. Instead of having the categories side by side, you can list the liabilities and equity after the assets all in one column. It all still needs to equal no matter the format. We're going to practice these three statements next, but first I want to show you an example of a real-life income statement and balance sheet that I prepared for a client. A copy of this PDF is available below this video in case you want to check it out. I left everything exactly the same except for I took their name out. Because this is only your first lesson, this might look a little overwhelming, and there's a lot of things in here we haven't discussed yet, but I did want to give you an idea of how this is set up. We have the revenue first. In this case, they call it fees. This is actually for a dental office, and their revenue account, they call it fees, fees from their patients. Then they list all the expenses, such as salaries, supplies, fees, rents, utilities, payroll, insurance, other things that you haven't heard of yet. There's a lot of expenses if you keep scrolling down. Like I said, you don't have to know all of these. These are for a real client, and you haven't been exposed to all these accounts yet on our first chapter. At the end, we have our net income. They made $1,600. That does not seem a lot, especially since their revenue was $265,000. They made about $250,000 in sales, but in the end, they really didn't keep much because they had so many expenses. Here's a balance sheet for the same company. Once again, you don't need to know what all these accounts are yet, but just look at the format. We have our assets here. We have our current assets, fixed assets, and I'll go over what that means more in a later chapter. But we list all of our assets to get our total, which is $18,000 worth. Then we have our liabilities and equity section. We list our liabilities. They have shareholder loan payables. And then they list your equity, which is different here because this is set up as a corporation instead of a sole proprietorship. Therefore, these accounts are different than the ones I went over with you. As you can see, we've added the net income here from the income statement. We get the total of liabilities and equity, which is $18,000, and it matches our total assets. This is our last classwork problem to work on, number 7. As of December 31st, 2017, Armani Company's financial records show the following items and amounts. We have cash, accounts receivable, supplies, equipment, accounts payable, the capital accounts at the end of last year, so that means the beginning of this year, and then at the end of this year. The owner's withdrawals, 2 revenue accounts, and then 3 expense accounts. These do go in order. And I think one of the easier things to do is to label the accounts before you start this problem. For instance, which are the asset accounts? It would be these ones right here would be my asset accounts. Then we have liabilities. There's only one account. We have all of the equity ones. We have the revenue accounts, which there was only 2. And then lastly, we have the expense accounts. We will be needing to use all these accounts to make the 3 financial statements. The first financial statement is the income statement. That is what you need to prepare in Part A. What accounts go on the income statement? It would be your revenue and your expense accounts. Remember, revenues minus expenses equals net income. From this consulting revenue down, all of these accounts will be listed on the income statement. First, we'll put in the revenues. which is the consulting revenue of $33,000 and the rental revenue of $22,000. Let's put that in. For the income statement, we'll start by listing the revenues. We have the consulting revenue of $33,000 and the rental revenue of $22,000. We will total this up to get your total revenues, which would be $55,000. Remember, we list everything on the left-hand side and total it on the right-hand side. Also, when it comes to labeling, we usually put the dollar sign on the first number of each column, and then at the end when we get our total. That's why the 22,000 doesn't have a dollar sign, because this column already has one here at the top. Now we need to put in our expenses. The expenses would be these three accounts here at the bottom: salaries expense, rent expense, selling and administrative expenses. We're going to list all of these three next. We'll put the category heading of expenses in and then list the three with their totals on the left side. Salaries expense of $20,000, rent expense of $12,000, selling and administrative expenses of $8,000. Total up your expenses to get a total of $40,000. All of these expenses here equals the $40,000. Lastly, we'll put in our net income or net loss. We will subtract these numbers, 55,000 minus 40,000. If it's positive, it's a net income. If it's negative, it's a net loss. What do we have here? It's a positive number. 55,000 minus 40,000 is 15,000. It will be a net income of 15,000. Remember, we will need this for our next statement, which is the owner's equity statement. Remember, the owner's equity statement begins with the capital balance at the beginning of the year. We will then add any additions to it, which would be our net income, which we just found in Part A, along with any owner investments. I would like to point out in Part B, I did give a hint that the owner did invest $1,000 cash into the business. So there is an owner's investment here. Other items that would go in the owner's equity statement would be the withdrawals. And then if there was a net loss, which there wasn't, there was net income. So we don't include the net loss line. When we total this up, we're going to get the ending capital. And this problem here actually gave us what the ending capital is, which is 7,000. So we know that when we put these numbers in, that's the number we should be getting at the end, is 7,000. If we're not getting that number, we're doing something wrong. So let's put these numbers in. We're going to put in the beginning capital first, plus the net income, minus the withdrawals. Let's do that now. We start by putting in Armani's beginning capital, which is $4,000. Then we do the additions. We'll add the owner's investment, which I said is $1,000, plus the net income that we got in Part A. We got $15,000 as our net income. Total this up for a total of $20,000. Then do our subtractions, which in this case is only the withdrawals. The owner withdrew $13,000 throughout the year. Our ending capital balance would be the $20,000 minus the $13,000 to equal the $7,000 at the end. We will use this $7,000 in our balance sheet. And we did get the right number, because remember I said that we were aiming to get a $7,000 because in this particular problem, they did give us the ending balance. Part C is to prepare the balance sheet. We're going to be using the accounts that we haven't already used. The balance sheet has our assets. We're going to list all of these on the left-hand side, our total assets. Then on the right-hand side, we're going to list our liabilities, which is only this one here, plus our equity, which is our owner's capital. It's the end of the year number that we got on our owner's equity statement in Part B, which was $7,000. These are the numbers that we're going to put on the balance sheet now. First, let's begin by filling out the left-hand side, which are the assets. We'll put assets in as our category heading and list all those assets that I had circled. cash of 10,000, accounts receivable of 9,000, supplies of 6,000, and equipment of 5,000. Total this up for our total assets of 30,000. Remember, the right-hand side needs to equal this as well, or we're doing something wrong. First, let's put in the liabilities. Remember, there was only one liability, accounts payable. So the total liabilities would be just the 23,000. What do we put in next? Equity. Remember, this is the owner's capital from Part B. It was our ending capital. So Armani's ending capital from Part B was 7,000. Now we have to total up our liabilities plus our equity to get total liabilities and equity of 30,000. These two numbers here match. We know we did this correctly. I know working on these financial statements seems a little much for our first chapter, but this really sets a tone for the rest of the class because then we're going to be learning about the accounts and how we get to these financial statements. If you need some extra practice or you're a little confused with these, please check out the resources, the tools I have listed below, especially the publisher videos, and they have some practice with that as well. This concludes Chapter 1 lesson. Make sure to submit the classwork for your participation and work on the reading assignment if you haven't already and the regular class assignment.